Thanks, Gavin, and good afternoon, everyone. When I say unrivaled, doesn't mean it was a great experience, but it's probably unrivaled nonetheless. So, welcome everyone. We will get you out for lunch on time, and welcome to our keynote session today, which is on how merger and acquisition activity impacts investment across the sector. As Gavin just mentioned, we're very privileged today to have three, I suppose, gurus in the space. We've obviously got Campbell Cooper here from Greenhill, Matt Fifield from Pacific Road Capital, and obviously John Tivey from White & Case. So I'll pass across to each of our panel members just to introduce themselves in a bit more detail, and then we'll get stuck into some of the conversations.
Thanks for that. As you mentioned, my name's Campbell Cooper. I work for Greenhill, which is a corporate advisory firm. We provide M&A and financing advice. I've been in the industry for about 20 years with Greenhill and previously with Goldman Sachs. For my sins, I started as a lawyer and actually worked with John, so I've known John for a very long time, and Gavin for that matter. We've been fairly active of late on transactions, including a takeover defence for Liontown Resources, Oz Minerals, and going back a couple of years, Kidman. So we've done quite a bit in the lithium space.
Great, thanks, Campbell. Yeah, Matt.
Thanks. Just checking. Can you hear me okay in the back? Okay, great. So my name's Matt Fifield. I'm the managing partner of Pacific Road Capital. We're an alternative asset manager, and we specialize in resources, metals, and mining. And so we trade both liquid stocks at the large market capitalizations, and then we also take more concentrated positions in small and mid-cap companies. Sometimes we're the only shareholder, and therefore some of my responses will feel like they're coming from the perspective of an owner or manager of a mining company. And then sometimes we're just a chunky shareholder of someone along the way. So the perspective that I'll bring today is our investment background, mostly in that frame, and where we're seeing opportunities, how M&A is influencing our investment plan.
Hi everyone, my name's John Tivey. I'm a partner in the Melbourne office of White & Case. White & Case is a global law firm with about 700 partners. We're in 44 jurisdictions. I specialise in the mining and metals space. I've been practising in that area for over 30 years now, both as an in-house counsel and in private practice. And as alluded to, we've been doing a lot in the critical mineral space of recent times, and so we'll probably touch on that a little bit as we go through the session today, but glad to be here.
Right. Thanks, John. All right, so we'll get into the M&A conversation. Might start with yourself, Campbell. And I suppose from your perspective, what does an increase in M&A activity indicate about the state of the market in general?
Yeah, thanks. Probably the first thing to note is the mining sector has been very active from an M&A perspective this year. It gets written a lot, and certainly we've felt quite busy for some period of time now, but actually got one of the analysts to pull the data, and by a fair margin this year in terms of announced M&A is by value is quite significantly larger than the last 10 years. And there's a few, if you sort of carve out the Newcrest deal, which is obviously a big chunk of that, it's a big transaction. Really, I'd say that the key theme driving it is critical minerals and electrification, whether that be BHP acquiring Oz Minerals for copper. There's obviously the Livent deal in lithium. As I mentioned, we're working for Liontown Resources, responding to Albemarle at the moment, which again is lithium. These are all really driven by a need to get access to critical minerals by large mining companies. And we certainly expect that theme to continue. Probably the other observation I'd make is that particularly earlier this year, that's a long-term trend. Equity markets can really get out of touch with that trend, and we saw it really probably January, February this year, where lithium stocks in particular were one of the most heavily shorted stocks. I think if you took the top 10 most shorted stocks on the ASX, a fair chunk of them were lithium companies. And really what turned that around was Albemarle making an offer for Liontown, which, given that shorting, it was an enormous premium. It was well in excess of what you would normally see for a takeover premium. So you do get these disconnects, I think, in equity markets, and we saw it earlier this year where equity markets perhaps are taking a much more risky perspective on critical mineral stocks than strategics are, and that when that occurs, I think you'll see a lot more M&A activity emerging in.
Thanks, Campbell. Matt, what are your sort of general observations on the M&A market?
Well, I think there's actually quite a few things that you talked about that are relevant. There's really a couple of markets. There's the battery chain and everything else, so you have to just realize that. One is a market that's desperately short, and so it's behaving like a market that's desperately short. And then the other is kind of bumping around. And the way that we were looking at it is last year, if you think about what an amazing, who could have predicted 2022, right? So all of a sudden, national supply chains that were just reestablishing themselves after COVID became completely disrupted with the Ukraine war. And then there's an energy crunch, right? And then all of a sudden, rates are popping up. So put yourself in the perspective of a board member. You don't know if there's going to be a recession. You're not sure if you can quote the price of steel for growth. There's so much uncertainty in the world. The last year, it was unsurprising to us that there was very little M&A. The world just wasn't in a place where there was enough stability for people to make decisions and say, I want to spend my capital this way, or I want to spend my capital that way. And, I'm going to leave, you guys are spending so much time and have so much to say in the energy minerals supply chain that I'll sort of tailor my remarks to the rest of it. There are some things that are relevant for both investors and for mining companies and aspiring mining companies that are happening on the M&A side. Take a look at what's happening right now with Glencore and Teck and the breakup of Teck. So on an M&A basis, Teck had oil sands, sold that for 1x, right? Has the best coking coal franchise in North America and one of the top 2 in the world, and is looking to spin or sell that, really to come back and say, hey, wait a minute, we're actually just a copper company. So there's a divergence in multiples that aligns towards future demand and some crossover of ESG. And I think that you'll see a continuation of that trend around how is the portfolio of my company aligned with the value that I'm asking the market to pay. All that aside from all the excitement in lithium and all the rest, it's notable because if you're a company thinking about M&A or positioning for M&A, you need to take that into account. And if you're an advisor or an investor, you need to be thinking about, will there be multiple expansion in the case of M&A?
Thanks, Matt. John, your observations?
Yeah, thanks. I think I've probably, when I was preparing for this, I was sort of thinking there's probably, and we've touched on some of this, there's probably a number of themes that kind of run through what's driving M&A and obviously, or what will drive M&A. I think decarbonisation generally is a massive driver, and I think one of the areas where that is relevant is that the majors are looking to kind of rebalance their portfolios. I think there are a few majors that are short in the critical mineral space who do need to do things to kind of rebalance that. And I think that kind of correlates with some of the other themes around what the juniors are up to, but we'll come back to that. I think ESG is driving activity, and I think you touched on it. You've got the base metals groups that have a mixture of hydrocarbon, kind of iron ore, hydrocarbon intensive businesses and less hydrocarbon intensive businesses are looking at ways to restructure their businesses so that they can meet the ESG expectations of their investors and their off-takers. And so we alluded to the sort of Teck / Glencore deal. Obviously, Vale-based metals is an ongoing process at the moment. And so I think they're indicative of the sorts of things going to happen in the market in order for those premiums in product to be realised because of the ESG expectations.
Well, I was going to say one thing that we've noticed is just on carbon accounting and ESG, it's actually a driver of divestitures, right? So we've seen, you're watching the stakes that were being accumulated by, in particular, say, Asian trading partners or downstream steel mills. Suddenly, they don't want the carbon on their books. They're happy to trade it, but they don't want the ownership associated with it. So you've seen a number of minority joint venture stakes from the middle of last decade sell in the last year. And then we invest in oil and gas. And one of the things that's also interesting, John, is we're seeing if you have a great project that also, operation that has the ability to make headway on the carbon intensity, you're going to allocate capital and scarce people towards that. So we're seeing more mid-range and very profitable enterprises being sold by mid-tier and majors because they don't actually want to have the carbon intensity. They want to keep the carbon intensity where their growth is going to be and where their leverage on people are, and spin out the carbon intensity and other things. So there's kind of an interesting marketplace developing around what is the ultimate, carbon per revenue, or however you want to look at it that way.
And I think the other observation I was going to make is that with decarbonisation, obviously we've had a lot of companies that are focused on the critical mineral space. I think there's a big challenge for those companies because of the markets they sell into don't have transparent kind of indexes that you can link their offtake prices to. You've had inflation impact on CapEx and OpEx. And so I think there is a lot of single project companies out there that are in a quite a difficult position, even though they have good projects with their business model. And that probably has two potential impacts, whether they become targets. But I also think what we are seeing is there's a move to kind of move away from what we would call the traditional iron ore integrated supply chain model where, for example, Rio Tinto manages the supply chain from mine to market, to a scenario where companies are bringing in third parties to their supply chain to market. And so you're seeing, for example, Chinese coming in and doing or other processing companies coming in and doing the processing part, and OEP, downstream motor vehicle manufacturers and battery manufacturers coming upstream and investing into those joint ventures. So they're sourcing capital. So that's creating transactional activity around that whole supply chain.
No, good comments, John. I think the whole issue around corporate advisory houses struggling to cover these emerging critical minerals is something to be conscious of and to be aware of. So some will say, yeah, we cover graphite, we cover lithium, so we'll invest in those, and all of our clients are across that, but we don't cover silicon quartz, we don't understand it. So it doesn't mean it's any less of an opportunity, it's just at the moment they just don't cover it because they don't have the research house and the bandwidth to do it. So, and just with that, I suppose it's a lead into, for everyone's benefit, how you guys actually spot potential M&A targets. So Campbell, do you want to maybe share a bit of insight around how you guys go about spotting potential M&A targets?
Yeah, sure. I always go back to the basics. If you go right back to, it's a term that's often trotted out, but long life, low cost ore bodies is usually a good place to start. There's a lot of explorers here and junior companies, and you can tell pretty early on in the evolution of a mining asset what it looks like. Is it going to be a big scalable asset? And inevitably the big scalable assets in good quality jurisdictions if you look through history, get picked off by someone at some point. So that's always a good place to start. There's obviously also just specific situations where there might be a stranded asset where there's a logical acquirer next door or something like that. Those ones are generally a bit clearer to pick. And I think on that theme, a lot of people often underestimate just how challenging it can be for a single asset company to bring a mining project all the way through from discovery to production. Clearly some people do it, but there's a myriad of challenges there that whether it be finding the capital, finding the people, particularly at the moment, finding the people to help you build the project, that inevitably makes management teams and major shareholders of these companies more amenable to M&A and engaging with a larger company on M&A. So I'd say that's a pretty good place to start.
Yep. Sage advice. John or Matt?
I think it's an interesting question, because what we've been doing is, and it's why I kind of have the themes that I have in my head, is trying to identify in the market single project companies with really good projects that are facing all the challenges that I've just spoken about, right? They've got a product that isn't linked to a third-party index. They're exposed to a jump in CapEx. They're definitely going to be exposed to a jump in operating costs, and trying to identify whether they're a target because they're going to be severely impacted share price-wise, or alternatively, whether they're likely to be a candidate that will look to seek investors in their route to market. And so we're going through the process of identifying those companies and then targeting them to sort of promote our offering in that space. The sorts of things that Campbell and I have been working on, they are what lead us to be able to go after those companies, right? So
I'm just going to add to that. Sometimes I've observed, particularly in North America, you can comment on North American investors, but a lot of investors in North America tend to focus on earnings. What's the potential earnings of this project as it ramps up in the first few years? And obviously that's important, but if you've got a mining project that generates great returns for 10 years versus one that generates slightly less over 40 years, if you're looking for M&A opportunities, it's always going to be the 40-year project that people want to buy. People want to buy projects that produce through cycles. They don't want to typically deploy hundreds of millions, if not billions, acquiring a mining asset that's only going to get them through one cycle, if that. So to your point on screening, we always try and work with companies that have really multi-cycle assets.
Yep. Matt, did you want to add to that?
Well, it's interesting, just to repeat the question, it's how do you spot M&A targets, right? And I think that the best way to spot, and it's such a broad question, the best way to spot an M&A target is to think about who's doing the acquiring and what do they want. And so because people don't just snap off M&A for any reason. There's a strategic reason that people undertake M&A. And so when you see someone that has a portfolio that has a lot of jurisdictional risk, and that jurisdictional risk is being, brought up, it makes sense that they will grow their project portfolio to have more Australia or more Canada or more U.S. and less, Peru, Argentina, and Chile, right? And so the drivers around that, where we haven't gotten to yet, are people consolidating in the battery mineral space around offtake synergies. That will happen. Ford is in this, so I'm going to buy this project because I have a great relationship with Ford, or because Ford wants me to own this because they trust me, right? That will happen. That's not happened yet. Right now, it's still a race for, can I find projects? And I think that the the other side is, for example, when we're working on the private or concentrated side, what we spend a lot of time around is totally away from the project and much more around business. And I think that one of the single easiest ways to start to prep your company to be attractive to an acquirer and ask them, justify, I want you to pay me a lot of money, is to start with things like sustainability reports, or showing up to the Responsible Steel Alliance, or knowing what your carbon is, or what your water usage is, or being a part of IRMA. And once you're in this ecosystem, it is a strategic landscape. That's what I mean. As a junior mining company, you're wrestling tons. Great, I have no money. How's this all going to work? But if you're actually trying to build something that somebody else wants, the acquirers are going to look at your project and they're going to say, okay, you have a baseline. I can improve on that baseline because I'm bigger, stronger, faster than you, but at least you have a baseline. So when I bring it to my board, you've covered off this category of risk, or you're positioning yourself for what my customers need. Therefore, I can see how you plug into my strategy, right? So it's kind of like thinking, when you're grooming a company or setting it up to be acquired, you need to think about what do your acquirers need, and therefore what do their customers need. That's why automotive transparency or consumer electronic transparency and having a position on human rights and being able to defend how you got there, that stuff is extremely important around M&A. And I have seen in a boardroom a whole bunch of people relax and say, all right, let's talk about this, or turn their nose up and say, you guys aren't even at square one. And it's very powerful in M&A. So one of the things that I look for in this room is who's doing that, who's thinking about not their project, but the business that they're trying to sell. And we look at that in the stock market as well.
You raise a really interesting point there, which particularly in battery minerals companies at the moment, a lot of fairly large companies that are, in terms of expertise, still quite junior. And if I go back to, we worked in 2017, 2018 for Kidman Resources, which they were in a joint venture with SQM. They ultimately got acquired by Wesfarmers. They had offtake arrangements with Tesla, amongst others, and it was really important to Tesla to have a really credible party like Wesfarmers developing that asset. Not to say that the Kidman team couldn't have done it, but clearly for a junior mining company, it was going to be much more challenging to develop a really large-scale asset. So I think the point you made around another driver of M&A, particularly in battery minerals, is going to be the supply chain wanting to see the right people owning and building these mines to really, at the end of the day, the likes of Ford, Tesla, GM, that they don't want to be in the business of mining. They just want to have that security of supply.
100%. And for the junior miners in the company or in the audience, I'll say something that I know will be a little bit disappointing, but functionally, Rio or Wesfarmers, they can form capital. So if you need $500 million capital, you don't need to worry about where it's going to come from. So that part's going to happen. It's going to be much lower cost than if you're trying to raise 2 times your market cap. And then if you hit a 1 or 2 year delay in your project or something starts to go wrong, but you're a part of a bigger blended portfolio, it's not mission critical. It's not a life and death outcome. So I think that, who's paying for the energy transition? Basically taxpayers, okay? Taxpayers and governments are going to subsidize this whole voyage, and through that, all of the auto manufacturers and everything else. But what they need is diversified people, portfolios that they can work through, that can deliver things on time, on budget, don't have to worry about where the money's coming from, all of the rest. So I think that the actual build out of this, there will be very few single asset companies that will successfully build out as this market matures and accelerates, and therefore you should expect to see more earlier stage placeholdings, blocks being made, joint ventures at the asset level and all of the rest as as sort of the capable and empowered market sucks up, the landscape.
Yeah, thanks, Matt. And I think that's a really good point, because if we go back to IMARC last year, I think some of the data coming out of that around the number of mines and sort of level of production that's required to meet these decarbonisation and net zero strategies and targets is obviously something the world's never seen before. So I think any insights around what the companies in this room in particular need to do to position themselves for fundraising, I think is something we could possibly share with them. And obviously also horizons, because we'll hear these stories about Apple and Ford saying, it's got to be decarbonised, we want to see new technologies around processing facilities. So there's obviously a mad scramble to secure and develop assets. So is there any sort of tips, I suppose, for some of the groups in the room around just positioning themselves for timeframes around some of this market activity coming on stream? And obviously a lot of it relates to Asia too, and China, because a lot of it focuses around China cleaning up its act. So any comments around that?
I have a purely Western perspective, so I'm actually really interested at the two of you, because you interact with a growing Asia much more than I do. For the companies that are in the room, it really starting baselines and showing intentionality around some of those transparency report, things that auto manufacturers and consumer electronic companies are going to need. Just starting to show even awareness on that goes a big way. The part that is challenging advice is that the best way to raise money in this market is actually to work as hard as you can to get liquidity, right? Because you need to, what you're finding right now is a lot of the companies in the junior end of the market are in too small a market tier. So actually, honestly, maybe a fund can write $1 million check, or you're reliant on individuals and high net worths to fund your business plan. And so that's where M&A or having multiple projects, leveraging the difficulty of a management team. If you have 4 or 5 projects, projects move at different speeds. There's more outs for an institutional investor. I would say, roll your company up with a couple other things that are not dreams, and you'll have a chance of appealing to a broader range of people because there's more outs, even though you're pre-revenue. Does that make sense?
Yep, sure does. No. Yep.
I think one of the challenges is around trying to come up with a development model that is going to be bankable. And so, as I said earlier, to try and kind of insist that you're going to stick with a kind of downstream processing all on our own kind of model, and particularly, it's a real challenge because a lot of host jurisdictions are requiring companies, single project companies, to further beneficiate their product in country before they send it off to market, which massively adds to the capex associated with the project. So, but a development model that contemplates a single project company funding that capex is not viable. So I think you need to come up with a model that accepts you're inevitably going to have other parties in your project, and work out what the profile of those parties look like, and work to build a model. As you say, you've got to deal with all the ESG stuff. Bottom line is the people like Ford, when they're coming into this supply chain to impose their ESG requirements up the supply chain. So you're inevitably going to have to meet their standards anyway. But I think the fundamental thing is coming up with a development model that kind of can stand up to all the factors that are impacting on the sector at the moment.
I think it is interesting that you're seeing, for example, the Queensland Vanadium Common User Facility. Like there are some things that are happening where suddenly, the next 2 steps of processing are going to be common user. That's because the world needs so much of it, right?
I think that's a really good point. Quite often, what equity markets want to see is, this particular company is going to go downstream and they're going to build out all I'll use lithium as an example. You know, we're not just going to mine spodumene. We're going to build a refinery. We're going to produce lithium hydroxide, and quite often equity markets get excited about that. But the reality is, to actually raise the capital for these projects, it's hard to do that from equity markets. You do need to consider strategics, and I think John raises a good point that a strategic will be looking straight through that and say, I mean, as a country, we're yet to produce any lithium hydroxide in any meaningful quantities in Australia. It gets talked about all the time. There's a bunch of projects, but other than a few bags, we have not managed to produce it in any meaningful quantities. So if you're a junior mining company that doesn't have a producing mine yet, talking about building a refinery, a strategic's probably going to look straight through that to the next story. They prefer the smaller, simpler stories, which I think is the point you're making, John, that that doesn't necessarily mean you can't move downstream down the track or anything like that, but getting the basic building blocks first is important.
I think it's a very good point, Campbell, and I think for people in the room, I think one of the key, partners in Australia in particular is our scientific institutes and our universities. So if you are trying to build a story around some of the things that the guys have commented on here, go and have a chat to CSIRO, go and have a chat to ANSTO, talk on the University of New South Wales is doing stuff in this space. So, and basically the critical minerals sort of project from the federal government and the list, etc. These institutes are getting priority over certain, whether it's lithium or quartz or graphite or whatever the processing decarbonisation technologies that they're working on. It's being allocated across these groups. So make sure you're out there talking to them to improve your story and give yourself a better chance of being invested in or acquired over time. And I suppose just with that, guys, just more broadly on the market itself, like what are some of the flow-on opportunities you're seeing from these record highs of M&A activity in the mining sector? Is there anything like obviously the financial services and the professional services industry? You're seeing any sort of movements in technology space, infrastructure, logistics?
Yeah, it won't surprise you to learn that as someone that provides M&A advice, I'm positive about the benefits of M&A. But I think one of the often overlooked benefits, and we're seeing it play out now, and I'll go back to the Kidman example that Wesfarmers acquired that company in 2018, I think it was, and that mine's now up and running and built. And I think if that company had have stayed independent, those that follow the spodumene price would know that spodumene went from, I think, around $700 at the time, dropped to a low of sort of 350 odd in 2020. We were working with Kidman on financing. There was a lot of interest in 2017, 2018 from banks, etc., to fund it. There's no way it would have got funded, and that would have been in construction over that period. And who knows what would have happened to the asset during the pandemic. Instead, you had a company with a big balance sheet come in, continue building it. I'm sure they had their moments where they got a bit nervous, but then, spodumene got to $7,000 a tonne last year, so I think they were pretty happy. I think the flow-on, to answer your question, one of the big flow-ons from these M&A cycles is that projects get up and running and get built, and that flows through to the industry continuing to evolve. It's amazing if you went back to I lived in Perth 2011, around that time, other than a couple of projects, lithium wasn't an industry. It was, and people used to say, Australia will never be competitive in lithium. Hard rock mines are a higher cost than brine assets in South America. We're now one of the biggest producers of lithium, and a lot of that has come through the benefits of M&A and large companies being able to invest capital to get these projects built.
Tell all your children to go into this industry because we're on the front end and we have a material skills gap, right? It's not an industry that has been successful in recruiting people. And we have a huge number of talented corporate executives that are going to age out at a time that the world needs more of what we do. So whether it's on, I tried to get my cousin to be a commodity trader, but anyways, we need more people. So that's one flow-on effect. and it's not happening. So that is an interesting. There is strange opportunity that's coming up out of legacy assets like oil and gas and coal, because the world isn't transitioning as fast as people as they want, but valuations are quite low despite a long runway. And we haven't, going back to Perth 2011, we haven't yet hit that point in time where people are actually really building much. I mean, a couple lithium mines, but not like a lot. So if you think about, go back to 2007, 2009, you couldn't buy tires for an ultra-class truck for 4 years. 4 years, right? And so the entire supply chain, when it's going through this motion, will gap out. So it will be Cat, Hitachi, pipe handlers, EPC contractors, engineering firms, distribution points, substations, concrete. The amount of things that are going to need to be mobilized to deliver on energy transition are staggering, and we're just not there. You're seeing a little bit of tightness in 220-ton trucks tires right now, but nothing like 4 years. And that has happened before, and it will happen in this cycle. So there are very interesting service sector and equipment knock-on, and then there's all sorts of cool stuff happening around autonomy and AI, but I'm not smart enough to win that discussion.
Just on a lighter note, I think one of the benefits is it's cool to be in the sector again, and so you've got to rebrand yourself as a critical minerals advisor rather than a mining advisor. And
well, you're an iron ore and coal expert.
That's right, exactly. And so you see Macquarie's investment banking team have changed their name to Critical Minerals and something like that. So rebrand.
Did they really?
All right, we're just about out of time, and I know everyone would like to get to their lunch, so we'll be hanging around. So if you've got any questions, please come up to us and ask. And otherwise, thanks for your attention today, and thanks to the panel members. Please give them a round of applause. And hope you enjoy the conference. And as I said earlier, IMARC, I think, highlighted what's in front of us. So make sure you stay in tune with all of those developments.